trillions vanished overnight. Not in a stock market crash, not in a war. But inside millions of Chinese homes, from the outside, China looks unstoppable. Ports are packed, factories run 24/7, exports break records. But just miles inland, restaurants are empty, apartments are losing value, families are quietly running out of money. And what's happening beneath the surface could reshape the global economy. Stand on the edge of Ningbo's massive port and nothing feels broken. Giant cranes stretch across the skyline like steel dinosaurs. Containers stack higher than buildings. Ships glide in and out with mechanical precision. Nearly 150,000 vessels pass through these waters every year. Oil tankers, grain carriers, towering container ships loaded with electronics, appliances, clothing, electric vehicles bound for Europe, Africa, Latin America. From above, it looks unstoppable. A machine that never sleeps. But drive just a few miles inland and something changes. The restaurants are half empty. Waiters stare at their phones. Live musicians sing to vacant tables. The historic waterfront district, once buzzing with art shows and late-night laughter, feels like a preserved museum. Beautiful, clean, but strangely lifeless. This is the contradiction. China's industrial engine is roaring, yet household spending is fading. The movement is there. The momentum is not. For decades, property was the foundation of Chinese prosperity. Apartments were not just homes. They were savings accounts, retirement plans, college funds, a shield against uncertainty. Rising housing prices became a substitute for social welfare. Families didn't need complex investment portfolios. They needed concrete and steel. And for years, it worked. Parents bought multiple units. Young couples stretched their savings to secure one before prices climbed again. Entire neighborhoods rose from farmland in months. Construction cranes dotted every skyline. The assumption was simple. Tomorrow's value would always be higher than today's. Then the floor disappeared. Developers defaulted. Projects stalled. Buyers stopped paying mortgages on unfinished homes. Prices began to fall, slowly at first, then faster. What had always gone up suddenly did not. Imagine waking up and discovering your life savings lost a third of its value, not in a risky stock trade, but in the apartment you believed was your safest asset. That shock spreads quickly. When wealth evaporates, confidence goes with it, and confidence is invisible until it's gone. Families stop renovating. They delay weddings. They postpone children. Dining out becomes a calculation. Big purchases feel reckless. Cash becomes sacred. Ningbo small business owners feel it immediately. A hardware supplier who once moved truckloads of construction material now sells a fraction. Sales down 30%. Some say 50%. Others whisper 80%. The parked cars outside shops belong to owners, not customers. There's no public meltdown, no chaotic protests. Just something heavier. A quiet withdrawal. This is not a typical recession. Recessions are storms. This feels like oxygen slowly thinning. Historically, property bubbles have reshaped nations. Japan, in the early 1990s, believed its real estate market could never decline. Tokyo land values once exceeded those of entire countries. When the bubble burst, growth stagnated for decades. The United States experienced its own reckoning in 2008 when housing markets cracked under excessive leverage. China's case is different in structure but similar in psychology. When housing becomes identity, when it anchors social mobility and generational security, its collapse becomes existential. Ningbo shows us something unsettling. A city can look alive from the outside while its inner confidence erodes. Ports can break records. Factories can run 24 hours a day. But if households feel poorer, the economic heartbeat weakens. The system still moves, but the reason it moves begins to fade. And here's the deeper question. If production continues rising, if exports remain strong, if the world keeps buying Chinese goods, why are families pulling back so sharply? But what happens next will change everything. On paper, the numbers still look solid. Factories hum. Export figures remain impressive. China continues to dominate global supply chains. High-tech manufacturing expands. Products once imported at premium prices are now domestically engineered and mass-produced. Efficiency is rising. But there's a hidden shift beneath this productivity. Modern factories do not employ millions the way they once did. Automation has replaced assembly lines crowded with workers. Robotics increase output while reducing payrolls. Precision replaces manpower. Production climbs, wages do not. This is the paradox. Exports grow, but household income feels fragile. Corporate revenue may rise, but everyday spending remains cautious. The machine is optimized for global demand, not domestic confidence. Ningbo's port is proof. Containers leave fully loaded. Yet nearby neighborhoods struggle. Overcapacity intensifies the pressure. China produces more steel, more appliances, more vehicles than domestic markets can absorb. To stay competitive globally, companies cut prices. Margins shrink. Profits thin. Hiring slows. Layoffs quietly ripple through sectors that once felt secure. The world sees rising output. Locals feel shrinking stability. Psychologically, this matters more than GDP. Economic behavior is driven less by statistics and more by expectation. When people believe tomorrow will be better, they borrow, invest, expand. When uncertainty creeps in, they retreat. Lower interest rates should encourage spending. Government incentives should spark consumption. But in Ningbo, much of that money is saved, not spent. Families choose liquidity over lifestyle. Because the issue is not cash, it is belief. Local governments face their own crisis. For years, municipal budgets depended heavily on land sales. Developers bought land, built towers, sold apartments, and the cycle funded infrastructure, public salaries, expansion projects. When property transactions collapsed, so did that revenue stream. Suddenly, cities had less money to build roads, schools, industrial parks. Public spending slowed after decades of rapid growth. Private firms received fewer contracts. Job creation weakened precisely when the economy needed support. The shock absorber became an amplifier. Historically, governments could stimulate growth through infrastructure. But if land sales dry up, financing becomes constrained, debt burdens rise, flexibility shrinks. Ningbo's mayor publicly acknowledged the strain. Industrial projects face delays. Foreign trade faces headwinds. Consumption remains locked. That last phrase is revealing. Demand exists, but it is trapped behind fear. Fear of declining home values, fear of unstable employment, fear of making irreversible financial decisions. Fear spreads faster than data. In quiet corners of the city, forklift drivers wait for temporary work that may not come. Tailors who once crafted expensive custom suits adjust to cheaper orders. Families plant vegetables in unused spaces, reclaiming a sense of control. These are not dramatic scenes, they are small adaptations. But multiplied across millions, small adaptations reshape an economy. This is not collapse in the cinematic sense, it is erosion. And erosion is dangerous because it feels manageable until it isn't. Exports can remain strong for years. Industrial policy can push high-tech sectors forward. But if domestic consumption remains weak, the imbalance grows structural. China's growth model has long leaned heavily on investment and exports. Consumption as a share of GDP has historically been lower than in many Western economies. That imbalance was sustainable during boom years when property wealth boosted confidence. Now, without rising home values to reinforce optimism, the imbalance is exposed. Output without internal demand creates fragility. Motion without momentum. And this is where the video takes a shocking turn. The real danger is not visible in container counts or factory output. It lives in expectations. For decades, rising property prices functioned as an unspoken social contract. Work hard, buy property, watch it appreciate, build security, fund your children's education, retire comfortably. That belief structured life decisions. When that belief cracks, the consequences extend far beyond real estate. Young couples delay marriage because financial certainty feels distant. Parents hesitate before committing to costly tutoring programs. Entrepreneurs postpone opening new businesses. Risk tolerance shrinks across society. Cash becomes protection, not fuel. This behavioral shift is subtle but powerful. Economies expand when money circulates. When households hoard savings, circulation slows. Businesses experience weaker revenue. Hiring declines. Caution reinforces caution. It becomes a loop. In previous economic slowdowns, strong domestic demand or aggressive stimulus could reignite growth. But restoring belief is harder than restoring liquidity. Confidence is psychological capital. Once eroded, it rebuilds slowly. China's industrial strength remains formidable. Technological innovation continues. Infrastructure capacity is unmatched. But prosperity depends not only on production, it depends on distribution. If gains concentrate within sectors that employ fewer workers, if automation increases efficiency without broad wage growth, if property no longer acts as a wealth engine, then households feel disconnected from national success. The port can thrive while families tighten budgets. This is the structural tension Ningbo reveals. The city is not unique, it is representative. A mirror reflecting a broader shift. Outward strength, inward fragility. Historically, major economic transitions rarely announce themselves dramatically. They unfold quietly. Japan's stagnation did not begin with chaos, but with slow adjustments. Other nations have experienced prolonged periods where growth statistics mask deeper social unease. China now faces its own crossroads. Can it rebalance towards stronger domestic consumption? Can income growth replace property appreciation as the foundation of confidence? Can local governments sustain spending without relying on land sales? These are not temporary questions. They define the next decade. For now, the machinery continues. Ships depart, exports flow, technology advances. But households remain cautious. The risk is not an overnight collapse, it is prolonged stagnation. A grinding adjustment where expectations recalibrate downward. When expectations change, societies change. Ningbo stands as a warning, a city that looks powerful from above but feels restrained at street level. A port that symbolizes global integration while neighborhoods wrestle with uncertainty. Trillions may not have physically disappeared, but perceived wealth, the kind that fuels confidence, has diminished sharply, and when perceived wealth falls, behavior shifts. That shift is already underway. The cracks do not scream, they whisper. The next part might completely change how you see this topic, because the real story is not about ships or skyscrapers. It is about trust. Trust in the future. Trust in stability. Trust that effort will translate into security. When that trust weakens, growth becomes mechanical, motion without recovery. Ningbo shows us that prosperity is not measured by output alone. It is measured by how secure ordinary families feel when they wake up in the morning. Right now, that security is fragile. The world sees the cranes and cargo, but the real story is happening in quiet apartments, empty restaurants, and cautious households. And that story is still unfolding. If you want deeper analysis like this, calm, investigative, and beyond the headlines, subscribe to Economic Tales, because understanding the cracks before they widen is the only way to see what's coming next.